Visit www.financialrepressionauthority.com for more information and make reference to the Roundtable Insight for applicable discounts on products and services. Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment. Now, here's your host, hedge fund manager Erik Townsend.
Welcome to the inaugural episode of the Financial Repression Authority Weekly Roundtable. I'm Erik Townsend. I'm a hedge fund manager. I also host the Macro Voices podcast. Joining me today as panelists are Mark Valek from Incrementum, of course, the publishers of the very popular In Gold We Trust newsletter, as well as Barry Habib, who is the founder and CEO of MBS Highway, with a very extensive background in mortgage-backed securities and bond markets. I'm going to ask both of our panelists to introduce them. Barry, why don't you kick it off? Give us a little bit of perspective about your background.
Well, thanks so much for having me. I'm proud to be on the inaugural version of this. Been surrounded within mortgage and real estate business for, I can't believe when I say this, it's 30 years. Created a product that helps people within the mortgage and housing industry understand what the bond market's doing, what the financial markets are doing, and how to advise their customers as to when to lock in their interest rates. Also have been a professional speaker for 25 years on the financial markets, and been on CNBC since 1992 and Fox Business with regular appearances. Had my own show on there for 13 years. Also created Rock of Ages, which is not related to the financial markets, but many people may know the Rock of Ages brand, which played on Broadway in many different countries and was a motion picture, which I was also in. So kind of a fun background.
Wow, okay. And Mark Valek is a fund manager and partner for Incrementum. Mark, tell us a little bit about your background.
Thanks for having me as well, especially as I'm calling in from Europe, from Austria. I hope you can handle my accent, but since you haven't sent Arnie back home, so I think that's a good thing for me. I'm very affiliated to the topic of gold, precious metals, but more broadly to the Austrian School of Economics. So I wrote a book, co-authored a book, which is called Austrian School for Investors. And we at Incrementum, which is a partnership of four partners, publish an annual report on gold, which is has been published this year for the 10th consecutive year. It's called the In Gold We Trust report, and it's followed well internationally, well over the world. And yeah, we look at monetary system and especially the systemic instability of the system, I have to say. So this is, I think, pretty thing which is very timely right now.
Let's dive right into the topic of the day. We are recording this inaugural episode literally just minutes after the Federal Open Market Committee announced that there would be no rate hike in September. And as I look, we're only 45 minutes or about an hour past that announcement. There was initially a big spike up in just about everything, with gold stocks going up, dollar index taking a nosedive. Most of that retraced initially. I think there was a full retracement in equities, full retracement on the dollar index. As we're speaking at just about 3 p.m. on Wednesday afternoon, as the FOMC press conference is still underway, it looks like equities are retracing again back to the upside, about 2147. Gold touched 1339, back down to 1334. What is the significance, gentlemen? Why don't we start with you, Barry, of no rate hike? This is pretty much consistent with most people's expectations. But in the bigger picture, where are we in this whole rate hiking cycle? Is there ever going to be another rate hike in this cycle?
Well, it tells us and confirms a lot of things that we did not think the Fed was going to hike rates here in September. However, I think what they did was really show us that December looks like a likely hike. You did have 3 dissenters, which kind of maybe shows a lack of leadership from Janet Yellen. She doesn't have people really in alignment with her. I believe that we will see a rate hike in December, kind of the same thing they did last year. They wanted to kind of get one in before the end of the year. So they said they can, we got one in 2015. They're going to want to get one in 2016. But also when you look at the dots, it just shows how out of touch so many of the Fed members are. You have one Fed member that thinks there's going to be 3 rate hikes between now and the end of the year. There's only 2 Fed meetings, so unless I think they're going to do a 25 and a 50, one of them at a no press conference meeting, which November meeting is not going to be live, they're just so out of touch. However, we did see within the dots that of the 16 members who did participate in that, 17, we did see 14 of them believe that there would be a hike, 3 that there wouldn't be a hike before the end of the year. So I do think it's very likely you're going to see a rate hike in December. What does that mean? Probably means that the equity markets do similar activity to what they did last year. I don't know if China likes it because China doesn't want us to hike, and that could cause some additional volatility. And believe it or not, as far as yields go and mortgage rates, you will more than likely see an improvement. I know it's counterintuitive, but you can look at history, and virtually every time the Fed hikes rates, you do see some money flowing into the bond market initially, and perhaps because it curbs inflation, perhaps because the equity markets see money coming out of bonds and into out of stocks and into bonds. But you do see an improvement, and I expect more of the same.
And Mark, what's your take on the bond hike?
Well, I have no doubt that the Fed would like to hike rates, but obviously they have some problems doing it actually. So I think they're doing like what Peter Schiff likes to call open mouth operations. So they're talking a lot, but they really don't do a lot. And from now to December, it's a very long time, and there can be a lot of stuff going wrong, which will once again prevent them from December. But even if they should hike rates in December, then the curve and the expected rate path by now is so flat that it could be the end of this very well anticipated hiking cycle. So this could actually, similar to last year, be dollar bearish in my view, and bullish for precious metals if they do it once and perhaps then decline their hawkish tone and perhaps go rather to signaling that was it. That's more my view.
I'd like to stay on rates, but let's move to the longer end of the curve and just talk about Treasury yields in general, because a lot of us, myself included, have had a view that we're going to see even lower yields. I have made the prediction that we'll eventually get to a 1% yield on the U.S. 10-year. And, I don't think that it sounds crazy, but it's really not. Look at, there's more than $10 trillion of negative yielding sovereign debt around the world. But boy, there's some awfully famous people disagreeing with me. We've got Jeff Gundlach at Double Line, major hedge fund manager, very well respected, saying, okay, that's it. The bottom is in interest rates. It's all uphill from here. Just last week, we had Ray Dalio say the credit cycle is over. So what do you guys think? Is there still a case for lower bond yields? What do you see in terms of outlook?
Well, that's a really interesting question. So, a little over a year ago, I made the call on the 10-year Treasury at 1.39. Did that based on some technical analysis and some fundamentals, and everybody thought it was nuts. Okay, it kind of got looks like, what are you smoking on air, But sure enough, we did actually dip even below that, but came pretty close to that as a target. And one of the things that I see now is a change. I actually thought that we'd be headed towards 1%. Had the exact same view as you. I now have kind of altered my view on that to some degree. I think we could see it if we were headed for recession, which I put at a little bit better than 50% chance over the next 24 months. We get a recession, yes, I'd see a 10-year Treasury note yield. However, in absence of an event such as that, I think it's difficult because I feel that things have changed around the world, and perhaps Mark can add some additional commentary and color and insights to this, because it was, see, if you're buying a bond today or a note, nobody in their right mind buys it with a negative yield thinking that I'm in this for the yield. I'm not going to buy it knowing guaranteed I'm going to lose money. You're just hoping that down the road, yields drop even further and somebody will buy this off your hands. And so you're carrying the freight until that happens by paying a negative interest rate. However, you think you're going to make money on the capital appreciation. Well, years ago, not that many years ago, people thought that, okay, zero was a floor and yields would never go below that. So that somehow limited your upside potential in appreciation and your downside potential in yield. But once we got to negative yields, and as you said, $11 trillion now in negative yields around the world, and once we did that and broke below zero, then it theoretically made upside potential in capital appreciation endless, and the amount of negative yield could be endless, infinite in theory. So everybody's paradigm changed, and that's what caused yields to drop so precipitously. So now we're seeing in Europe, and we're seeing certainly in Japan, this move back towards zero, where perhaps they're saying, look, I'm not going to push the button anymore, because like pushing on a string, I'm not getting the desired results that I would want, so I'm not going to do more of the same. And therefore, with them coming back to zero, what this means now is that, hey, maybe we aren't going to get as much capital appreciation. Maybe it truly is limited. Maybe downside in yield truly is limited. And in absence of an event, I don't think this means yields go much higher because we don't have much inflation. But I don't think they're going to go much lower. And I think that, as you know, with any market, we've seen it kind of move up in treasury yields of late. It doesn't take a lot of selling. It just takes a lack of buying. And I believe that's what we're having now. Look at the most recent treasury auction, worst bid to cover ratio in 7.5 years. So I think people are saying maybe zero is a floor.
Well, let's ask Mark, because zero has not been a floor in Europe. And I think his perspective would be very welcome.
No, definitely not. And things are getting more and more crazier by the day, although the last weeks, actually, we saw a little bit of a rise in interest rates on the long end. For instance, if you look at the most extreme examples like Switzerland and so on, which have rising yields on the long end, but still are in the negative territory. So this is all still upside down. Calling the bull market in bonds, which has been going on for about 35 years, is obviously quite a tough task. I think, personally, I would expect more of a blow-off event, from the bond price perspective, because I mean this has been such a ride. And if you, I think, go through 101 on technical analysis, a major bull market usually doesn't have to be, but usually ends with a blow-off. And I mean, you could argue we had the blow-off or going into negative territory in some major markets. US obviously hasn't been there. So my gut feeling is I'm rather in the camp that it's not over yet. My other gut feeling is that the one thing that really could and probably at the end of the day will end this bull market is inflation. And inflation is not a topic on the financial markets, rather deflation or disinflation still is more dominating the discussion. And the latest move in a correction, if you will, in long-term bonds, I think was rather triggered from less than expected stimulus from ECB or Bank of Japan, and I think they can't stop actually. So we are all debt addicts, and we need this low interest rate environment, and they can't stop really to decrease the dose. So I think the ECB will again enhance their stimulus program after March 2017, and Bank of Japan also disappointed a little bit in terms of increasing their stimulus just today or yesterday actually. So they may try to also taper it down, if you want to use that term. But I think they just the debt situation will at the end of the day prevent them to really stop these QE programs and so on. So at the end of the day, they will have to increase once more, which could then bring this blow off in treasury and bond prices.
Yeah, I agree that we haven't seen that, what you call blow off or climax sale. I agree we haven't seen that, or climax buy or climax. I agree with that. And I'm not saying that we see a reversal to the upside in yield. I don't think yields go much higher, but I do think for the time being it's going to be difficult, even for the ECB or for the Bank of Japan, and right here in the U.S. to justify pushing rates below zero because they haven't yielded the desired result in any of the experiments where they've taken place.
I'd like to ask both of you guys about an aspect of this that I find fascinating, which is there's an argument that central banks would love to go deeper into negative interest rate territory, but they really have to ban cash before they can do so. And for any of our listeners who are not familiar with that argument, it is essentially that when you have negative interest rates, it creates a financial incentive for people to hoard cash, put actual banknotes in a vault someplace, rather than having them in the fractional reserve banking system. And in theory, there could be a run on the fractional reserve banking system. There's been quite a bit of talk lately, big prominent people like Ken Rogoff from Harvard, publishing papers saying we need to ban cash, and a lot of governments are saying it's necessary for terrorism. Do you think that there's a possibility that this is maybe a pause and we're eventually headed to even lower negative interest rates, but governments have to rally around banning cash in some way before they can do so?
I saw the Rogoff interview that he did recently where he talked about perhaps taking the $100 bill out of circulation because it's too, I don't know. I think it's a bit of a far cry. I don't really see that happening.
And Mark, your take?
Well, it was pretty obvious a few months and I think even a year ago here in Europe, they had big media attention where more and more people came out with this idea with all kind of arguments, arguing against cash. At the end of the day, they now really got rid of the biggest note, which was the 500 euro note, which isn't being produced anymore. But also more and more people would like to decrease this cash in circulation, exactly also what Ken Rogoff said. I think they will have a very difficult time getting this through, honestly speaking, especially for instance, in Switzerland, which of course is not part of the European Union, but Central European country nevertheless. But it's just very difficult for me to imagine that the Swiss people will go along with it, and they still have a lot of say because the direct democracy. So the intention for me, from their perspective, I obviously can understand, because what is negative rates? That's basically a haircut, isn't it? So as we are all chronically in debt, they want a way out of it. And if you silently can cut the amount of outstanding debt by negative interest rates over the years, that's a very elegant way of getting out of it. But it's on the other hand a very blunt way, because I think it's more obvious than, for instance, the inflation tax. So it's perhaps the plan B if they really are not able to bring in more inflation into the system.
Can I just tag on to the inflation talk, because it's really interesting here in the U.S. The Fed, for whatever reason, fooling themselves or not, looks at the personal consumption expenditure, or PCE, which and the core rate is now 1.6% year over year. But they're not paying attention to the 10 months in a row of CPI, the Consumer Price Index, being over 2%, which is theoretically above their Fed target, and actually at 2.3% most recently. When you take a look at the CPI, I believe, and I haven't gotten anyone to dispute this, that it more accurately reflects real inflation, because it has a higher percentage allocated of costs for a roof over your head, as well as out-of-pocket medical expenses, both not reflected in the PCE. So on a more accurate level, there is some inflation, and you could argue above the Fed's target rate of 2%, yet the only person on the Fed to even bring it up has been Stanley Fischer, everybody else ignoring it and looking at PCE. So, perhaps with this wide divide of 0.7% between CPI and PCE, you may have more Fed members and more people saying, hey, perhaps we should look at CPI. Certainly the bond market does.
That's an excellent point, and it's something that I have said for many years is, although there's no sign of inflation right now, boy, are we in trouble when we eventually get runaway inflation, because suddenly the central bankers' hands will be tied. They won't be able to resort to all of this, conjuring money out of thin air in order to save the market, because inflation will be a problem. It's not here yet, but it's coming someday.
You're dead on. Remember, Fed's kind of like, we know how horrible they are at forecasting. We know that none of them have ever even run so much of as a lemonade stand. I mean, Richard Fisher was the only guy with business experience, and he's gone. Now, you've got a group of Fed members here that had promised us when we entered into QE how easy it would be to exit it, right? Oh, it's so easy to exit. And now Janet Yellen and Jackson Hole says, this is here to stay for a while. So it was all BS, wasn't it? And that's the thing about it, is the Fed will change the rules and move the goalposts as it suits them. Remember the Ben Bernanke, okay, 6.5%, that's our threshold. 6% unemployment rate. I mean, 6.5%, that's our threshold. Then 6%, then 5.5%. I mean, he kept unmoving the goalposts. It reminds me, and I don't know if you remember this, I was a big Bugs Bunny fan when I was a kid. Him and Yosemite Sam, he puts the line and says, I dare you to cross this line. I dare you. And he keeps crossing the line. And that's exactly what it seems. It's almost cartoonish the way this Fed has comported itself.
Oh, I couldn't agree more. We have covered, I think, interest rates pretty thoroughly. I'd like to move on to the effects of what's going on with monetary policy on asset markets, and particularly real estate market. But let's start with equities, because, boy, there is just a growing chorus of really famous people, whether it's, Carl Icahn, Stan Druckenmiller just had a comment last week coming out from Ray Dalio. Of course, George Soros is massively short. Lots and lots of people are saying, look, the game is over here. The equity market is tremendously overvalued. We're probably headed towards a recession. I just interviewed Raoul Paul last week, who said, look, the business cycle is just way long in the tooth here. There's a lot of really smart people saying something's got to give, and it's, expect a really big downside move in equities. On the other hand, I've thought that quite a few times since 2009, and the tape has proven me wrong. So is it finally at the point where this charade is over and central bankers' ability to elevate asset markets is maybe coming to an end, and there's a loss of confidence event coming? Or do we still have room to play this out? I want to let Mark comment next, because Barry and I just took the stage quite a bit. What do you think, Mark?
Well, that's a tough one, because I think, again, it depends once more on the actions of the central bankers. It may be the case that if, for instance, the recession hits, where one usually would expect the equity markets to go down, in the reaction of this, I think central banks will definitely continue with their interventionist policies. I mean, that's the reason that they are there for, manipulating the price signal. And as we alluded to just now earlier, Ken Rogoff and all these guys are actually now thinking about what could they do to give more stimulus, go more into negative, do more QE, do helicopter money. We know all these discussions, do more infrastructure from the fiscal side. But this one call I'm very definite about, and I guess you guys would agree, they will not stand by idly when we really run into a recession. And if they do a big one, whatever it would be, a combination of monetary and fiscal, then I wouldn't bet that equities really have to tank. At least in nominal terms, but perhaps they'll tank in real time, in real terms. And what really could tank is the dollar, because the dollar has been expecting this rate hike cycle, which is really more of a joke since the last 4 years, basically, where they announced the tapering of the third round of QE. And what have they done until then? They actually were able to stop printing money and raise interest rates for 25 basis points. So that really wasn't a big achievement, if you ask me. And if this really turns around, all these expectations which made actually the dollar the relatively greatest currency could really turn sharply, which may nominally hold up equities at the end of the day. So I think one really has to look at things like, for instance, as Dow Gold ratio, which is quite a nice indicator if you ask me. So the Dow Jones or any other equity index priced in terms of gold, and then you get a different picture, I think. And I'm looking for for these kind of ratios to go down. So priced in gold, I think we will see a bear market in equities.
Barry, what's your take?
My take is that the stock market is frothy. You have high PEs, but the PEs are almost very difficult to compare historically because you've had a change in the way that we have options expense, because options-based accounting has changed. You no longer take a hit to the bottom line. So PEs are actually suppressed artificially when you compare them to other periods of times. Record stock buybacks, which optically makes PEs look better. So you have a very interesting situation where although PEs today are somewhat historically high, maybe you could justify it based on the low rate of the Fed funds rate, but if you were to compare the same metrics that you would have measured them in the past, they'd really be higher than what they are now. But again, the goalposts have changed, the rules have changed to kind of fit what's going on here. And here's the thing too, is that people are buying stocks today, not always necessarily because of capital appreciation. They're doing it because they have no other choice, because of yield. You know, there's a very famous picture that you all may know when they were creating the Chrysler building of all these construction workers on a skyscraper on an I-beam, many, many, many floors up, and they're very comfortable at that altitude working and even sitting and relaxing. But that's kind of like people in the stock market that are normal traders. Well, today, what you've done is you put grandma up on that I-beam sitting up there, because you have folks that aren't accustomed to this, not comfortable with this type of risk, forced because of a lack of alternative to take risks within the stock market. And if and when it turns, and you know it's just a matter of when, it's going, you know, the stock market has a way of inflicting the most pain on the most people at the worst time. And the music is going to stop one day. And we are going to probably see some big issues and some big problems. We know what it can cause. So I agree with a lot of the smart people that you've been hearing from and talking to, because they've just got the experience. They know that these things, it's not a matter of if, it's a matter of when. And when always comes at the worst possible time.
I want to move on to real estate, because it's a topic that I know is near and dear to a lot of our listeners' hearts. A view that I've had for many years about this is, you know, I think we have an entire generation of people who have just become accustomed through culture to this idea that you buy a house because there's so much appreciation that you make, and you're crazy to ever rent because you're throwing money away. I think this is all a reflection of this secular bull market in bonds, bear market in interest rates, and it has to come to an end someday. And I wonder if we're getting close to that. Barry, this is your area of specialty. So what's your take on real estate, U.S., Canada, globally for that matter?
Real estate here in the U.S. has a lot of legs still. Very high demand, very good demographics. When you look at birth rates of millennials, they're going to continue to. Median age of a first-time homebuyer is 33. So you have a crop of 33-year-olds coming in greater than the next, increasing amounts for the next 9 years. It's going to surpass baby boomer birth rates. In addition to that, you have very, very low supply. Foreclosures, virtually non-existent. The amount has diminished rather dramatically. You only have 1.4 million units for sale. That's 1.5% of the market. It's typically in that 2.5% range. You get into trouble when it's at 4%, 3.5% to 4%. So you're going to continue to see very high demand. Rates of home ownership are very low. That's not a bad thing. That's a very bullish thing for the marketplace as far as real estate goes. It was bad when there was 70% home ownership in 2005, because that meant you didn't have a lot of renters to continue to push things along. So all of the factors are still in place. When you look at household formations versus completions, the first time in 15 years, you had more formations than completions at the end of the last calendar year. So we have, in my opinion, a really strong real estate market. Now, look, it's regional, it's you know, local, but overall, by and large, real estate's going to remain very strong for several years to come, and people can make a lot of money in real estate if they would stop listening to the media, who doesn't understand that when they talk about real estate, there's two ways to talk about it. There's real estate, the economic driver, and then there's real estate, the investment. Real estate, the economic driver, because of lack of inventory, has fewer transactions, so they get it wrong in the media, because they don't understand that that's actually a good thing to have fewer transactions because of lack of inventory to support pricing. So yes, love real estate going forward. Made the call on air December of 2011 saying the market was going to turn. Everybody thought it was crazy. They said it's not going to come back till 2015. It was pretty much the exact turning point, but the same factors as far as affordability and all the things that I mentioned that were in place then are still in place really, really strong. Home prices going up does not necessarily mean they're less affordable. It's also a function of incomes. It's a function of interest rates. And right now, when you weigh out all of those factors, really strong for real estate going forward.
Excellent. And let's look at this from a European perspective, Mark.
Yeah, Erik, I couldn't agree more with your statement that real estate, especially here in continental Europe, are a function of interest rates. You see, for instance, German-speaking languages are savings rich, and with the negative interest rates, we are really the middle class really is flocking into real estate. The savings accounts from the banks are being plundered and being moved into real estate. These regions are not so. The population is not favorable towards investing into securities. So I think that's a little bit of a cultural difference. But they love real estate because they also were quite well off with their real estate investments, whereas most of the guys probably invested into securities like equities at the wrong times because of psychological reasons and so on, because you usually go join the party when it's rather close to the end, and then you tend to lose. But real estate had a steady price increase, and it has started to increase during the last few years, and I think that's 100% a function of interest rates, as you said. And as long as this environment is like this, the fundamentals for real estate look good. But perhaps one word of caution or two. I mean, obviously, if the situation changes, everything changes, that's clear. But I think due to this situation of the indebtedness, I think I would be cautious to invest too much into this asset class, because it's an asset class which can be very easily taxed. And, Europeans, especially European governments, like to tax more and more. And so real estate is a place which you, perhaps from an investment point of view, you make the right decision, but after taxes, it wouldn't necessarily look that well in a few years' time. So it will be quite interesting to see what's going to happen.
Gentlemen, this is a really great conversation. I really appreciate both of your perspectives. Unfortunately, we are running out of time. So I'd like to ask both of you, why don't we start with Barry? Just give our listeners who would like to follow your work, what's your website? How can they contact you?
mbshighway.com. MBS, like mortgage-backed security, mbshighway.com. And my email is barry@barryhabib.com. Thanks for having me.
Fantastic. We appreciate your participation. And Mark?
We are visible at incrementum.li. That's INCREMENTUM, incrementum.li. And we publish some pieces from time to time. If you're interested, just drop your email. We'll appreciate that.
And I'm Erik Townsend. I also host the Macro Voices podcast, which is a podcast focusing specifically on high net worth individuals, family offices, and other sophisticated investors. We publish Thursday evenings at macrovoices.com. On behalf of Financial Repression Authority, thanks very much for joining us for our first episode, and please tune in every week for the Financial Repression Authority Weekly Roundtable.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.